BofA Securities Francisco Blanch joins us to discuss, I guess, nat gas first, Francisco. I've seen a bunch of charts today, most oversold in 7 years. This one handle got people's attention today. Is it close to a bottom?
Hey, Carl. Yes, we think it's close to a bottom. Obviously, we've had a very warm winter. We've also had a lot of wind generation. And also on top of that, remember, we've had Freeport gas locked up in the U.S. That's 2 BCF a day for 7 or 8 months. So that's about 400 or 500 BCF that didn't get out of the system. So we have high inventories, and we've had the weather going against demand. So I think we're getting close to the bottom for gas.
Right. Overall, on energy, I saw one firm today raise their demand forecast for the year by quite a bit, largely pinned to China. Is that the mode you're in right now?
Yeah, I mean, look, I think China is going to be driving demand for oil, emerging markets generally into the next 18 months. But it's been a little slower than we expected so far. Remember, the first couple months after the China reopening, we've had a big spike in COVID cases, which I think has led to people just locking themselves up rather than government-driven. But what we hear is that passport issuance and all that fun stuff is a little slow. And, of course, as we know, U.S. to China flights are still running extremely low. I think there's about 12 flights a week between the U.S. and China, world's two biggest economies, just have less flights a day than just a couple of minor cities in the U.S., to be honest.
Yeah, that's interesting. I actually read some pieces that argue that it's that trans-Pacific jet fuel demand, not just the inter-Asia travel, that's going to be the missing link, so to speak, in at least commercial transportation demand for energy.
That's right. And I was in the Middle East last week, and they told me, I said, look, we're getting the 380s ready because we know when Chinese tourists come out, it's going to be big. It's going to be massive. So right now we're in the mode of driving. So it's kind of the same as we saw in the U.S. and Europe. Drive now, fly later. So people are driving more. We're seeing gasoline driving the petroleum market. And I think we'll see the middle distillate complex, diesel and jet fuel, drive things farther into year end and into 2024. But remember, the Chinese have $2.6 trillion in savings. That's just about the same number the U.S. had, frankly, after all the government transfers a couple of years ago. That's what's created the economic boom in the U.S. in the last couple of years, and the Chinese have it in savings. So I think if the government allows them to spend it, and I think they are trying to get them to spend, we are going to see a good pickup in demand over the next 18 months. But maybe in the short run, it just takes a little longer than everyone's expecting.
Yeah, I was going to ask, Francisco, isn't that well known, the China reopening risk? Shouldn't that already be in the price? Instead, we've seen oil prices move the other way, whether it's a strong dollar or the new Fed expectations. So,
right.
So it's hard to figure out sort of which one matters more.
Well, I think commodities are real-time assets, unlike bonds and equities, which are essentially trying to price in future expectations. Oil is reacting to conditions today, and conditions today, as I said, are a little weaker because you don't have the full force of the China reopening hitting the demand side. It will, just maybe in 6 months, 12 months. But I think at the same time, we've had very lax Russia sanctions. Remember, the market was preparing for a big disruption in Russian oil supplies, and instead, thanks to the moves by the U.S. Treasury to encourage the price cap, the relaxation of the shipping lifetime bans that was initially in place, the relaxation of rules of origin remember, if you're a Turkish refiner and you're buying Russian crude oil, whatever comes out of your refinery is Turkish diesel, so it's no longer Russian, and it can be sold into Europe. So it's a big musical chairs game where we haven't really taken any chairs off the table, and Russian supplies continue to grow against the market expectations,
right.
which were for a meaningful decline in supplies. So that's been another factor, I think, driving prices lower.